Hello, everybody. This is Maj Swedan, Geo Investing with a management morning briefing. We've had a few of these with Crexendo. Stock trades on the NASDAQ at CXDO. It's a SaaS UCaaS cloud communications company, but I think it's more than UCaaS these days. We'll talk about that maybe at some point. But we have today here, of course, as usual, Doug Gaylor, CEO and president of Crexendo. Well, we're awesome and really delighted to have Jeffrey Korn, the recently newly appointed CEO of Crexendo. And I think this is Jeffrey's first appearance on a format like this. So we're really happy they just agreed to do this. And so we're going to learn a little bit more about Jeff today, touch upon the company's Q1 earnings report that recently was out. And we'll just go there and we'll go through the outline after we go through some of the terms and conditions for Geo and the safe harbor for the company. So hang in there, Doug and Jeff will be right with you.
Yeah, great. Thanks, Maj.
This discussion is for informational purposes only and is not an offer or solicitation of an offer to buy or sell securities. This is not a recommendation to trade, buy, or sell any companies discussed. We recommend you consult with a professional investment advisor before transacting in any securities mentioned in this discussion. By viewing or listening to this event, you agree to the terms and conditions, which you can view in full at geoinvesting.com. Premium members can also view our disclaimers at portal.geoinvesting.com. Please also be aware of the company's safe harbor, which explains that this chat may include forward-looking statements that currently represent the company's views, opinions, and statements, which may or may not materially be representative of future conditions and events. Thank you.
All right, let's move on here. So, we recently had your first quarter numbers, Doug, Jeff, and maybe we can talk about that for a few seconds here. You had sales upward nicely, 12.5 million versus 8.2 million. The non-GAAP EPS was flat about 2 cents, in line with estimates from analysts. I think what was interesting, and we'll get into later, is that you had some finally, some nice organic growth that we've been waiting on, So you're doing some things to maybe focus on profitability and understand that's important for the market. So that's anything on the first quarter here, Doug, you want to add, or Jeff, before we get into the outline?
Yeah, I'll just start with just the fact that we had really nice organic growth, as you talked about, in most of the organization. We had 26% organic growth in our software solutions division. We had 17% organic growth in our recent acquisition of Allegiant out of Kansas City. We had 4% organic growth out of our telecom services. So overall, a double-digit organic growth, and really pleased with the momentum that we're seeing starting the year.
Great, excellent.
And I think the key is, you took the quotes out of what I had said in the press release, is we are really concentrating at this point on organic growth and combining the companies that we have acquired and making sure we're one lean machine and getting all of the cross opportunities from all of the acquisitions. So we made some substantial changes. We stopped the dividend so we could keep saving cash. We put the brakes on looking at acquisitions, although always in the background. But this year we wanted to completely concentrate on organic growth and making the company better. And I think we're doing a really good job of that. I'm very impressed with. I give most of the credit to Doug and the rest of the team. I just sit there and preach.
Excellent. Thanks, Doug. Thanks, Jeffrey. We'll get more to that and we'll take us right to the outline here. So we want to talk about, we'll expand a little bit more on Q1 and some of the strategies you're taking. We also want to meet you, Jeff, and learn about your background and what brought you to Crexendo, how long you've been there. And we want to delve into your increased emphasis on profitability as a company here. And I think it's important in this environment. Maybe get a little bit of an industry update, as we usually do, Doug, on what's going on. There was some stuff, some activism involved with Ringcentral and 8x8 not since our last conversation. And for any of you that are new to Geo Investing or didn't catch it last time, we do have our last Skull Management morning briefing with the company occurred on March of 2022. And Doug actually at that point talked about the competitive landscape going on in the industry. So and let me go. I'm going to go a few more slides here, Doug, real quick, and Jeff for our members of Geo, so they get a little framework about the company, some financials and things like that. So hang on tight, we're almost with you. So here the stock's about $1.80. Outstanding share count 25.7 million. Market cap of 47 million. PE ratio trailing 11.2. EBITDA is a 16.5. PE ratio, our sales ratio is 1, EBITDA sales ratio 1.1, cash 3.69 on the balance sheet. Long-term debt about 3.1 million, includes some current portion of a note payable. I'm assuming that's part of the acquisition that they recently made. Here's a price history over the last few months, and then here's a little bit of the kind of revenue and earnings summary here. As you can see here, the company's been growing revenues pretty consistently over the last several years. They're running at about I guess a $48 million run rate now, $50 million run rate now. We want to talk about some of the estimates moving forward in terms of the estimates are 52 million in 2024 and 57 in 2025. I want to maybe understand how we can ramp up a little bit, and if that's possible from the current business point of view. And then we have earnings here. This company's been a long road here to produce earnings. When I first found the company, they were just going to profitability. This is maybe going back maybe 2016, 17. And it's good to see that they're kind of reaching consistent profitability, hopefully here soon, moving into next year especially. And we want to learn more about that, if there's any way we can see upside in these numbers. So let's go back and get into the outline here. So Doug, Jeffrey, thanks for being here and sitting through that. So Jeff, let's talk to you, Jeff, first. We've really done a lot with Doug over the last several years. He probably wants to sit back and rest a little bit before we grill him a little bit. He's been through the gauntlet already. So it's your turn. So let's talk about, Jeff. I mean, I know I think you were an attorney or maybe lead counsel. I'm not sure how to put that title with the company at Crexendo. So maybe talk about how you got to Crexendo and what you were doing at Crexendo, and why you're the fit for the CEO role over here.
All right. Well, I am an attorney. I was the chief legal officer of Crexendo, and actually I've been here 20 years. I'm the longest standing employee. I was here from its previous business model, and without tooting my horn, I'm the only person less from the previous business model. I've been involved in public companies probably for the last 35 years, both as an advisor, as a board member, as an attorney for companies. So I know what shareholders want, I know what boards want, and I know what employees need. So I've got a lot of that background. My being CEO was somewhat fortuitous. Steve had mentioned the board that he was thinking of retiring, and I thought that might be a good time for me to slow down a little bit and maybe work at a part-time position with the company. And the board said, we have some other ideas with Steve leaving. Steve is always, publicly when he said that Doug, Ron, and I run the company. So they thought that they should formalize that, and they asked if I would be willing to come on as CEO and keep the team together so we could continue spearheading and working toward the growth that some of the results you gave, and I'm sure we're going to continue to do. So I was honored to do that. One is very lucky to get to work with people they really enjoy working with and get up in the morning and love their work. So I saw no reason not to do it. Talked it over with Doug and Ron and the rest of the management team, and they were all excited. So we figured we'd give it a run.
Excellent. So, Jeffrey, one thing, I gotta be honest, when I first heard, you were going to be the CEO, and like, what does the legal department have to do with running the company? So, but you've been with the company for a long time. So give us an idea of, what makes you so qualified to do this, right? I mean, I guess you see all the contracts. I mean, how intimate are you with the business outside your kind of confines of being?
I've always been intimately involved with the business. I mean, we're a highly regulated industry. Attorneys have a keen understanding of that. I have a keen understanding of the business. I've been here from before Doug, when we started to turn it into a telecom. We brought him in shortly. So I've seen all that. I've done all the regulatory work with it. I've worked with the entire management team. I've been intimately involved with business prior to that. As I said, I've sat on numerous boards and represented companies. So I have an extreme business background. We all work very well together. And I believe the board and the rest of the management team thought that this would be a good fit. I know what I'm good at. I know what the rest of the management team is good at, and we work very well together.
I would assume there's some unique perspective you can bring to the company too, from that understanding contracts and seeing contracts, and that probably gives you a little bit of insight into the industry and how it's kind of interacting, maybe even on the sales and marketing part of the side of it, even though it's not sales and marketing.
everything at a highly regulated company goes through legal. So I always saw everything going on in the business. I reviewed every contract. I reviewed every marketing piece and would discuss them with them. So it was an easy transition. And I'm sorry, I think we cut off Doug.
Yeah, and Jeff has also been instrumental in all three of the acquisitions that we've done over the last 2.5 years, Maj. And so, knowing our business as well as he does, and knowing the acquisition targets that we've acquired, is just made for perfect synergy there. So, as we look at all of the opportunities that are out there, Jeff has been instrumental in making those acquisitions happen and getting us to the point that we are.
Excellent. All right, so I'm going to skip the emphasis of profitability here for a second. I want to move on to that because I think it's going to all tie into understanding the industry a little more, what's going on in the industry. And we've talked about this before, Doug. So there was some activism, going on here at Ringcentral and 8x8 here with an investor. I think was trying to get involved, maybe combine the companies. So maybe Doug, Jeff, you can expand on what you think that he was trying to achieve there, why that opportunity for him or the activist arose, you think, and maybe what it says about the industry and what it means for Crexendo. I think there are some implications there, right?
Yeah, I'll go first if that's okay. As from what we've seen, there were some activists who thought that the companies would be combined together. There's a lot of reasons, at least in my opinion, and I think Doug shares that it doesn't make sense for them, but that's really none of our business. If they were to combine, it tends to create disruption in the industry, and disruption in the industry is good for us because people start getting new reps, new people, and they're not happy and they look for other suppliers. We are very stable here. You end up talking to the same people. You can pick up the phone and talk to me if you're a customer and you have a problem. Try that at Ringcentral or 8x8. It ain't going to happen. We have very loyal, satisfied customers, and we'll continue to do that. I think, as you were prefacing, the industry has changed. Ringcentral, 8x8, and many other companies in our industry grew exponentially by borrowing cheap money and paying obscene multiples to acquire companies and/or revenue. And at the same time, they were paying spiffs to sales agents that made a 4 or 5 year contract unprofitable for the entire term. This is something we were never willing to do. We run our business on fundamentals. The fact that this has stopped a lot in the industry because of the high cost of money now, and because there are so many companies in our field who are suffering because they overpaid for acquisitions and are now having to pay a huge interest rate, really helps us, because we genuinely believe if we're on an equal playing field with a sales rep or with a company, we're going to win because our solutions are better, our people are better, and we work better with both on the wholesale side and the direct to sale company side than we think most of our competitors do.
Yeah, excellent. And I think that's a great explanation. I guess it came to a point where when money was cheap, it didn't matter how you could just keep kind of financing those unprofitable decisions by continue to raise money, either equity or debt wise. And that kind of pyramid scheme eventually has to end. I guess that's what we're seeing, but more so maybe at 8x8. And so this is good. So basically now if this situation going on, that the fact that maybe Ringcentral, 8x8, and other players can't do that as much anymore, puts you guys more of an equal kind of playing field when you are out there bidding for business and stuff. So that's really good to know. We'd love to see. Are you seeing any traction at all from this yet? I mean, have you seen, in the competitive landscape when you're out there bidding on stuff? Have you seen this stuff playing out? I mean, are you seeing more of an equal playing field yet, or is it still too early to tell if that's going on here? And
yeah, it's our industry, Maj, has always been ripe with M&A opportunities, and blink an eye and something happens and changes in our industry. And so, Ringcentral and 8x8 both had some challenges at the end of last year, had some fairly large cuts in their organizations, some reductions in forces that were pretty significant. And 8x8 had to go out there and renegotiate their debt, and so both of them have been kind of defocused from the mission at hand. And what that has done for us is create opportunity, because Ringcentral and 8x8, with their reductions in staff and some of the challenges they've been facing, their customer support and some of their direction has been lacking. And so when that happens, obviously folks that have been aligned with them look for better alternatives. And so we've been able to pick up a lot of good opportunities from folks that aren't as pleased with Ringcentral and 8x8. So whenever we see disruption in the industry, it's good for us. Vonage, who's another one of our large competitors, was acquired by Ericsson a year ago. And since that acquisition, Vonage has had a lot of challenges, a lot of change and turmoil going on. And again, that creates opportunity for us. So when we see opportunities like this happening, as Jeff said, whether it happens or not is out of our control. But if it does happen, that's good for us because it'll create a lot of fear, uncertainty, and doubt, and hopefully drive business our way. And if it doesn't happen, it's going to keep these guys at least preoccupied with those discussions because the activists aren't going to let up. They brought it up. They're pushing for something to happen. So Ringcentral and 8x8 have other things that have them be focused on their mission at hand. We're very, very focused on our mission at hand. So we're not getting distracted. If this happens, great. If it doesn't happen, that's okay. Either way, it's creating opportunity for us that we're picking up. And sales, as I mentioned in our previous discussions, sales for the first half of the year from a bookings perspective have been off the charts. And so we're extremely excited about the momentum we're seeing. A lot of that is being driven by some of the uncertainty with our competitors.
And just to emphasize what Doug just said, yes, we clearly watch our competitors, but our focus is entirely focused on making our business better every day, closing our sales, and generating additional cash and profit for our shareholders.
Beautiful, beautiful. And by the way, all you on this call now live, if you have any questions, you can raise your hand and ask it, or put it in the chat room. One last point here on, I guess, or two last points on this subject, and we'll move on to some of your focus on profitability and maybe some of the vision you have for the company together now, Jeff and Doug. So when Ringcentral and all these other companies are making cuts, do you see opportunity potentially to maybe pick off some of these sales reps that were with those companies, or do you think you got what you need? And I know you don't want to spend a lot of money right now on it. We're trying to focus on profitability, but I'm wondering what that looks like for you guys.
We don't want to spend a lot of money on additional people because we've got our core team and we're very satisfied with it. But people leave, and if some super salesman or saleswoman were to come in from one of those competitors, we would certainly consider it.
And we have seen that, Maj, just some recent hires on the channel side. We've picked up from Avian, from Mitel, who've also had some challenges, as well as a recent acquisition from a previous employee at Broadsoft. So, we're seeing as folks get terminated from these other organizations, we are picking up some new talent.
Great. One last thing on this whole thing here, Jeff, is I remember, I think it was, I don't know which call it was on. Were you on Q4 too, or were you on 2022, or were you all on the Q1 call?
I was not CEO at the time. I was on the call. I may have said something.
Right.
Your recollection may be better than mine.
I think it was a question where someone had asked you, like, I don't know if it was asked, where maybe you kind of came out and said it, like, what makes you not sleep at night?
Oh yeah, I'm sorry. I was CEO, and that was my first day as CEO. I wasn't officially CEO until the next day, but I did. And I recall my answer because it does still keep me up. I was concerned with, particularly then, the stock was about 40 cents lower than it is now. Somebody trying to come in and pick us up at thinking it was a bargain, maybe offering us double or 2.5 times the price, which we think would be substantially undervalued, but would create issues for us. So I'm still concerned about that. But to add, what really keeps me up at night is, my and our obligation to our shareholders, my and our team's obligation to our almost 3.5 million users on our platform. That keeps all of us up at night because we take that very, very seriously. We take generated cash seriously, and we take profitability seriously. And while I can't, and Doug and I can't control the stock price, we can control how we operate the business, and that's what we remain focused on. And I am concerned about somebody trying to steal us at a low price, but we just have to keep plugging along.
Right. I think that is a situation either from a company potentially or even an activist to get involved, right? Who sees potential there, and so the faster you get your stock up, the less attractive that becomes to them. So on that note, the best way to do that in this new market environment where it is focusing on profitability. I know I've beaten this conversation, this whole topic for a long time to death here, but we are in this new environment where that wasn't around before 2002. I mean, obviously, cash flow and profitability is always important, but it's what you pay for it, right? That matters at some point. It changes over time. And as you know, the Ringcentral for trading at, crazy 20 times revenue and multiples, want to disregard the PE ratio part of the equation. And now that's all changed a little bit. So, Ringcentral's come down to I guess, I don't know where, maybe 2 or 3 times revenue. I don't know exactly where it's at, but then when you have like an investor looking at Crexendo, right? And an investor looking like an Ringcentral, when that evaluation gap is kind of narrowed, unfortunately, the Ringcentral coming down. The fight now becomes, I think, to get is profitability in order to attract investors now, and that's kind of the challenge you're in, I think, going to be in right now. So how do you get this profitability moving, maybe at a better pace than maybe analysts are looking at? Let's focus on the bottom line first before we focus on the top line goals, and give us a reference point. I know you don't give guidance, but give us an idea where these expense reductions are coming from. And I think we can probably put the pieces of the puzzle together at that point.
There's current expense reductions. We've done a really excellent job of combining all of the 2 large acquisitions we've just done and moved people across the company. That has enabled us to take out about 15 requisitions of employees we were going to have to hire because of all the synergies we've done. So that was an immediate savings. We're looking at every single contract. We're renegotiating everything and making sure that they apply across all of the companies. There's power in the additional users and contracts. We're working on that. Doug's been spearheading that and or the rest of the team have been spearheading that and doing an excellent job. You'll start to see some substantial cost savings there. As we've talked about on calls, we have 2 different systems set up. We have the Crexendo Classic system, which is an excellent system, and we keep posted here in Arizona and other places. And we have the NetSapiens acquisition that we acquired because we think it's the best switch in the industry, and it's the 3rd largest switch in the United States. So we're very proud of that. And it became very clear that there was no need to continue to have the expense of 2 separate switches. So we are in the process of moving all of the customers from Classic to the VIP platform, which is what we call the retail sales of the NetSapiens platform. And that will have substantial savings. We won't have the high costs of running a separate platform. We will have 4 or 5 engineers and 4 or 5 additional support people who will be able to move into other parts of the company, which will save us another 10 or 12 requisitions that we have over the next 2 years. So the cost savings are going to start to be substantial. That will be adding to both our that will be adding to our bottom line, and will be better for investors, be better for the company, and enable us to invest more money back into the company to make sure our services are always, as they are now, second to none. Doug, you want to add anything?
Yeah, as Jeff mentioned, we're always looking for cost-cutting measures as we've done some of these acquisitions over the last 2 or 3 years. As contracts come up, we renegotiate or reevaluate. As an example, the NetSapiens acquisition, when we acquired them, had offices in La Jolla, California, fairly expensive office space. That lease came up at the end of last year. We promptly moved out of that facility that was oceanfront property in La Jolla and moved it to a much more reasonable spot. We're saving probably $30,000 a month on that decision.
By the way, that was hard for all of us. I live in Austin, but I'm here all the time, and the people here having a place to go in San Diego in the summer from Phoenix. It was a hard decision for us to give that up, by the way.
But making those types of things,
yeah, for sure.
And making those type of decisions, is all about managing to the fundamentals. So that's just one example that saved $360,000 this year. But other examples are pretty prevalent within the organization as contracts come up and we can renegotiate. Whether it's a $10,000 savings or a $350,000 savings, it all ends up.
And by the way, we're eating our own dog food here in Tempe, as we've mentioned in AK on the conference call. We're in the process of selling this building, which will wipe out most of the debt you showed before, because most of that debt is based on the mortgage. And by the way, the only other portion of that debt is a note payable from the Allegiant acquisition, which we're paying out of proceeds from Allegiant. So we really are essentially debt-free, and we'll be pretty debt-free once the building is sold. And we're moving into smaller spaces because we really don't need the amount of space here, especially when we've moved all the customers off of Classic. So that will be another substantial savings. This has been easy for me. We always manage the business to fundamentals. As I talked about before, before I didn't have to change course as CEO. We didn't, look for the panacea of cheap money and put ourselves in a hole we couldn't get out of. We always managed business to fundamentals, and we're just continuing to do that. And we all will continue to do that because, as you mentioned, the world has come back to fundamentals, Maj. We've just always been there. The world has just come back to us.
Okay. And so, and by the way, I'm sure some of your staff don't like you as much as they used to like you anymore, Jeff.
Actually, sometimes they like me a little bit more. I told a story at a town hall. Our CRO came into my office last week or the week before with a contract, and he said, "You won't accept this change they want." And I looked at it and I said, "I'll accept it." He goes, "What changed?" I said, "I'm responsible for revenue now. That's what changed."
Okay. So if I'm trying to, get an idea of these cost savings, is it coming out of more of the this, like when you move over your legacy to the NetSapiens platform, are you getting cost savings on the on the gross margin side, on the COGS side, or is it going to be on the operating expenses, or a combination of both? That's the first question I guess I have on that.
Yeah, combination of both, really. So if you look at it right now, we're operating two separate platforms. So we've got the NetSapiens platform that we run. We've got about 30% of our customers, direct customers, on that platform. We've got 100% of our platform resellers on that platform. And then we've got 70% of our direct customers on our Crexendo Classic platform. We're migrating those customers from the Classic platform over to the VIP platform, as Jeff mentioned earlier. And right now we're about 30% through that migration. We anticipate being 100% complete on that within 12 to 15 months. As we migrate those customers over, Maj, we'll see considerable cost savings more towards the end of that migration strategy. But when we migrate everything over, we won't have a need for the additional data centers where we've got Classic today, which means that we eliminate the support on those data centers. We eliminate the circuits on those data centers, the overriding cost and equipment and warranty and maintenance cost for all the equipment in those data centers. So it's fairly considerable. So we've got a really, really big push right now to migrate those customers from left pocket to right pocket, and doing a tremendous job on getting those customers migrated over. And it's an advantage for the customers as well, because they're moving to a platform that's got more features, more functionality. So for those customers, as we migrate them from left pocket to right pocket, we're giving them new features, new enhancements at the same price structure that they had. So it's a win-win for them, and it's a win-win for us. And so our target is to get everything migrated off. We've got an internal target of 12 months, but more realistically 15 months to get all of those customers migrated over. And that's about the time frame that we'll be out of this building. So the cost savings will be considerable as we eliminate the support and need for those additional data centers.
And 12 months from what, you think Q1 basically? Is that what you're thinking? Or
yeah, probably 12 months from now.
15 months.
12 months from now. So I would anticipate by this time next year, we should be wrapping up most of that migration strategy and seeing some extremely nice cost savings.
We're very specific about it when we tell the engineers that 12 months from now, because when you tell the engineers April, they'll tell you you didn't tell us which year. So we're pretty careful.
Yeah. Now, do you know if analysts are baking any of this stuff into their estimates at all, like these cost savings you're talking about?
Some, but not all. I mean, we haven't been able to quantify exact numbers on that. So, when we think about, some of those cost savings, we've got some of that built in. We've got pretty specific discussions with our analysts. We've got 3 analysts that cover us. We've got B. Riley, we've got Lake Street and Northland Capital. And so as we have those discussions with the analysts, they know the same thing that we're discussing with you on our long-term goals and 12 to 18 months on having things migrated out and additional cost savings. So they probably got some of it built in, but we haven't been able to give hard, fast numbers on here's the exact number that you'll see in savings, but it is going to be significant.
Okay, so if we want to try and take a crack at modeling some of that, we could go back, I guess, to your pre-NetSapien days and take a look at what some of that margin profile was then, and assume some percent of that's not going to be there anymore, because right now it's all of that probably plus whatever you got in NetSapiens.
Correct.
So obviously is it going to be 100% eliminated, because there's going to but there's some percentage there we could start assuming there, I guess, to start playing around with a little bit. I mean, is a 50% too much of an aggressive thing, or you can't even comment on that at this point, like in terms of the expense savings of your
50% of our
cutting out
Crexendo cost? That's probably a little aggressive.
Yeah, I think if you look at the operating expenses from pre NetSapiens acquisition, 50% would be a little aggressive because you've got engineering and cost of goods also in those operating costs, and so I think that's probably a little aggressive. But again, when I talk about significant savings, it will be sizable savings because we have a lot of support and maintenance agreements for these additional data centers that we've got on our classic. And so as that goes away, those numbers alone are 6-7 digits. So
And some of the savings, as I mentioned before, are not exactly quantifiable. We're getting the dividend of not having to hire people that we're able to move once we have classic off. So it's not an actual cost savings, but it's a cost savings of what we knew we would have to spend. So internally we mark it, but you necessarily won't see it. It's preventing us from having to spend additional monies in the next couple of years.
All right, cool. It might be interesting to consider at some point in the future, either trying to really taking that quantifiable expense you think you can get saving, maybe actually just putting it out there in a conference call or a transcript to say, here's what we know we can do. There's more than this, but here's maybe what we know. We put our fingers on what we can save. And I think that will maybe give some investors insight into how they can start modeling and getting an EPS number out there too. So just food for thought.
That's great suggestion, and we'll work with Ron. We'll add that to Ron, our CFO's plate. He always likes when we throw another project at us.
He's out of the office today. That's the only reason we volunteered him. Otherwise, he'd probably be watching it come in and going, "What?"
Yeah, another thing. Great. So, all right, cool. So, in terms of revenue wise, you are seeing some organic growth right now from your different positive revenue. You're optimistic this can continue to be maintained and some respect to your move for it.
We're both very optimistic that organic growth will continue to grow, that cash flow will continue to improve, and EPS will continue to improve. We're both convinced of that, and we're very excited.
And the main driver for that, Maj, as you look at the market today, again, only 50% of the U.S. business telephone market is migrated to the cloud. So 50% of the U.S. businesses today still haven't migrated to the cloud. That's a huge runway, and that's a tremendous opportunity for us. And as I mentioned earlier, some of the challenges that we've seen with our competitors is creating opportunity for us. We get on the direct side of the house, 80% of our business on the direct side of the house comes from agents and resellers. And these agents and resellers have lots of choices out there. And those choices are some of our competitors like Ring and EGHT and Vonage and others. And as those guys have challenges and those guys go through disruptions, they're looking for stability. And we're probably the most stable telecom company out there. And so, it's driving a lot of opportunity for us. And as I mentioned earlier, we've seen tremendous growth and momentum in our sales bookings for the last 6 months, and those bookings turn into revenue. And so, we couldn't be more pleased with the momentum right now, even with all the headwinds of, the recessionary times out there. We're still seeing a lot of robust business opportunities. Funnels are strong and bookings are strong.
Excellent. All right, Doug. Thanks, Doug. Thanks, Jeffrey, for being here. We'd love to do this again in the future, as maybe either at the end of Q2 or end of Q3, see how things are going. Again, we've been here with Doug Gaylor, COO, and CEO Jeffrey Korn, new CEO. And thanks a lot. And we'll do this again in the future.
Thank you, Maj. It was our pleasure.
Thanks, Maj. Greatly appreciate it.
See you guys.
Take care.